head west now for some insight on what's going on. Michael Yoshikami is Chief Investment Strategist at YCMNet Advisors. He joins us from San Francisco, where he oversees $1 billion in assets. Michael, welcome to Close. Thanks for joining us. Let me ask you, first of all, about Greece. I mean, you're way over there in California. How much does it matter? How important is this to you?
Greece is a huge deal because really what's going to happen is the markets are going to follow basically what happens in Europe. That's really the driver. People concerned about Chinese inflation. They're concerned about double dip possibly in the United States. The biggest issue is, are we going to have a ripple effect from a default in Greece, and what's it going to do to the euro? So it's a huge deal. That's why the markets are up right now.
I do have to, I mean, you have been telling us the last few times that you were on, time to rotate into bigger, more internationally exposed, maybe safer, more quality names here. That was sort of the beginning of when everyone else started to do that. So you got that call right. Does that make your clients safer here no matter what happens in Greece?
Yeah, you know, I think our perspective really is to invest as if there's going to be more bad news. You know, I think not only is there going to be continued troubles in Greece, and let me be clear, Matt, I don't think Greece's problems are going to be solved. They're just going to kick the can a few months down the road. In the end, there's going to have to be write-downs in Greece. But the United States is still going to be troubled by what I would call a sluggish, stumbling recovery, and Asia is going to slow down. So yes, our strategy with our clients is to get more conservative. If the markets go up, great, we participate. If they go down, we have some protection with dividend paying cash flow-oriented stocks.
All right, hang on a second. We just want to take people down to the New York Stock Exchange for a second as we hear the ringing of the rattling of the closing bell. June 21st, 2011. Adam Johnson down there with the final numbers. Adam?
Yeah, Matt, the famous closing bell, right? The S&P finishing up about 1.3%. You see that right there, 1694. Granted, they're still counting some of the last trades, but you see the Dow also. Strong day on the Dow. Look, up a hundo, 108. That puts it at 12,189. And finally, the comp, that's been the big story, up 2.2%. The comp at 2687. The volume, I know, I don't usually like to talk about volume because we get sick and tired of talking about volume, but you got to note that it was the 5th or 6th quietest day of the year. They're still counting the shares, so we'll see what the final count is. But again, ahead of that big Greek vote, and we get that result in about an hour, and ahead of the FOMC tomorrow, traders down here telling me they don't really want to take big positions. They like the update. They'll take it. Most of these guys playing from the long side. But, Michael, I want to know how you're playing this thing, because you actually tend to take a much longer term view, much more thoughtful. You're not looking to just day trade this thing. What's the trade for you right now?
The trade from us in terms of our portfolio strategy is to not put everything in stocks. I think that even though it's very exciting, we hear the closing bell, bottom line is I think you need to have assets in commodities, gold, because there's going to be continual fear in the markets and in the public's mindset, I think, as well as fixed income assets. And then the equity assets that you do buy, you got to go overseas. You cannot just rely on the larger, more industrialized countries, United States and Europe. You just can't rely on that. I think it's going to be too choppy.
Let me ask you about that commodities play, Michael, because obviously the big run-up in commodities that we saw, well, I shouldn't say obviously, but a lot of people think that was linked directly to the Fed's quantitative easing program. So do we see more quantitative easing here?
You know, I think it's possible. It depends on what happens with the unemployment numbers. I was of the mindset that there would not be quantitative easing. The more I look at what the numbers look like in terms of housing prices, as well as what's happening with unemployment, makes me think at the very least, Matt, we're going to have quantitative easing defined as the Fed just talking the markets up, just using the right language. I think if things get uglier, there will be a quantitative easing program. And if Greece continues to have problems, I think you'll see global quantitative easing. So, you know, I think that the thing you have to understand about commodity strategy is commodities have benefited from really a weak dollar. That's really what's driven a tremendous amount of the commodities rally. But you have to look at what's really happening on an underneath basis, on an underlying basis. Commodities are going to be driven forward because people are going to migrate more out of stocks and more towards tangible assets that they have faith in.
You know, kind of on that note, although in this case we're talking about creating money out of thin air, and PIMCO's Bill Gross has been talking more about kind of borrowing and spending. Suzanne, we heard from PIMCO's Bill Gross earlier about job growth or the lack thereof and what he wants to do about it.
We did, Matt, and he's really blasting the government, both Republicans and Democrats, saying they're focused on the wrong things. They have it all wrong. Cutting debt in the U.S. is not going to create jobs. We talked to him earlier. He has some simple ideas for creating jobs. Let's listen up.
in terms of putting people to work. We have a over 9% unemployment rate, and it's fiction to assume that those people can all move to Silicon Valley and to create the next Facebook. We need to put them to work doing something and producing a product that the rest of the world wants.
So in terms of producing product, he says it's very simple. Let's look at things like the Recovery Act, the $25 billion efforts that focus really on infrastructure, building roads and buildings and things like that. He says we need more of those things. How about focusing on programs that we're depending on for the future, like clean energy? And basically his message, Matt, is less college. He says college is a waste right now because you're not going to get a job, so why rack up student loans? Why spend the money? Instead, learn some hands-on skills. And another thing he's sounding off about, he made these comments in a very detailed essay, great read if anyone's interested in it, but he also says that repatriation tax of 35% is really shooting us in the foot. We're hurting ourselves here in the U.S. He says we need to bring that down. Government is sort of catching on to that, we're hearing. They may be looking to lowering that tax rate, and then perhaps CEOs would bring that money back here to the U.S. and expand their businesses and create jobs. GE, for example, has over $90 billion, according to our government estimates, sitting overseas, and they don't want to pay a 35% tax on that money, Matt, and I really don't blame them.
Don't go to college. Learn a trade instead. That's interesting advice.
That's very simple, simple. But he's right? Where are you going to get a job?
Well, I don't know that he's right. I would think that a liberal arts education allows you to pursue a number of different opportunities if you need to, whereas technical education is pretty narrow and focused. And if whatever you learn goes out of fashion, you'll have nothing to fall back on. Well, that's my own personal thought. You know what? I shouldn't give so many of my personal thoughts. Let's get back to Michael Yoshikami here, and we want your personal thoughts. What are you into right now? I mean, we were talking about the fact that you have rotated into bigger names, quality names. You've been telling Carol and myself that for months and months now. So what stocks do you like right now?
So I think from a technology standpoint, let's look at a few different sectors. From a technology standpoint, we still like, even though it's at a very high price right now, certainly over the last 2 years, IBM. We think they're going to continue to capture market share. We like Oracle. We think Oracle, with their acquisition of Sun, is going to compete successfully, particularly given some of the challenges that you see at HP right now in terms of leadership rank. In the financial services area, we think Citigroup will actually bounce back pretty strongly over the course of the next several years. It's going to be choppy on the short term because there certainly are problems with real estate still, but Citigroup's been able to construct that good bank, bad bank system that I think will successfully help them to increase their earnings.
Let me freeze you there, because sure. We've been getting so much bad news on financials. They've really been whatever the opposite of darling. They've been that of the stock market lately. Exactly. Downgrades for Goldman Sachs, earnings prospects. I've been hearing left and right about guys on the street getting fired. Literally, people, over the last couple of weeks, trading desks getting taken out here. And in general, I mean, the Basel requirement rumors floating around don't make people very happy either. I mean, is it the right time to be investing in financials?
I think the fact that you're asking is at the right time, people are getting fired, that there's such negative sentiment, I think that makes it the right time, as long as you're very selective. I don't think you can go out there and buy anybody, because there certainly are shoes that are going to drop. But Citigroup is a special situation. When the government dumped in as much money as they dumped in and actually required Citigroup to restructure their business, so they have really two different divisions, one having the problem assets, one having the quality assets, and considering Citigroup is the name brand around the world, I just got back from Asia, and one name you see that's a United States bank is Citigroup. So I think it's a special exception. I wouldn't go buy a financial services sector asset by any stretch of the imagination, but I think Citigroup is an exception.
Sorry, Julie, we have Adobe earnings crossing. My wires were getting crossed here. Adobe earnings crossing, you mentioned them earlier, so what are we looking at? So
it looks like sort of some mixed pictures here. Adobe, really the key issue for Adobe is a new version of Creative Suite. That's its suite of graphics software, everything from Photoshop to DreamWorks, which helps you design websites. It's used by a lot of different graphic design professionals. And Adobe, in addition to sort of updating the technology, also rolled out a new version that's a subscription version. You don't have to buy it in one shot here. You can actually subscribe to it. So if you're a freelancer and you have intermittent work, this helps you do that. But take a look at the stock here, because the company came out with second quarter earnings and sales that were above estimates. However, the third quarter earnings and sales forecasts leave the company some room here. some wiggle room both on the upside and probably more relevantly on the downside. So third quarter earnings going to be 50 to 56 cents. Analysts were looking for 54. Revenue is going to be $1.05 billion. The estimate is 1.02. So again here, there's a little bit of wiggle room. That's obviously making investors a little bit nervous here. The shares are only up about 4% for the year to date, so you don't have necessarily a big run up in anticipation of this, although the shares did rise about 3% in today's session, and much of that is now going away in the after hours, Matt.
All right, so there you have Adobe earnings. Let's get back quickly to Michael Yoshikami. Interestingly, you're taking, it seems like a contrarian position there as far as the financials. I assume that's not the case. I'm looking at a list of your picks here on Johnson & Johnson. Regardless of all of the recalls that we've seen, it seems to be pretty much in favor with investors here.
Yeah, I think it's a boring name, lots of cash flow, international expansion, healthcare sector, low PE, and pays a dividend. This is exactly the kind of name that investors are going to move to when the volatility gets too high. That's why you started to see these names come back into favor. That's why we started moving into these names 6-9 months ago, because we were anticipating this type of volatility that we're seeing in the market right now. So I think these are good core positions. You don't hold them forever, but they're good core positions for the time being.
Quickly, I want to get to Chevron here. Only about 30 seconds left. Why do you like Chevron? And well, I guess if you think that oil is going to keep going higher, but what's the most important move you want to see there for an integrated?
Integrated oil, it's basically energy is going to continue to go up. I think once emerging market restarts, and it's going to stumble a while, but once it restarts, we're probably going to see oil prices above $100 a barrel on an ongoing basis. And if that's the case, I think you want to be in integrated oils, because I think when the economy starts to come back, people start driving more, you're going to see energy become in favor again.
Got it. Michael Yoshikami, thank you. A pleasure as always. Michael Yoshikami there from YCMNet Advisors.